A happy morning to all of you. This is Magdalene from Itus Capital, and I'm glad to welcome you all to our 3Q Investor Call 2023. Thank you all for taking the time to be a part of our Saturday call. At this time, all the participants will be in listen-only mode, and after a brief presentation by our founder and fund manager Naveen Chandramohan, we will have the Q&A session. So today, Naveen would walk us through on our portfolio performance in the last quarter and discuss his views on the market. Let's hear from him. Over to you, Naveen.
Thanks, Magdalene, and good morning to everyone who's taken time off to join this call. So before I start off on today's call, the theme of today's call is thinking about positioning. One of the things that I've always maintained is as a fund, you're not picking stocks, you're investing in a certain portfolio. And constructing a portfolio, it's important to think about how you position the portfolio, both from a market cap perspective, both from a sector perspective, as well as then coming into a stock selection as the third priority. Now, there is an underlying theme in each one of this, which is cycles. So through this conversation and presentation, I aim to take you through the importance of understanding about positioning, and more importantly, how do we think about it at Itus? We'll start off this presentation by going over our quarterly, yearly, as well as since inception performance. So this slide breaks down the performance of the portfolio since inception of the fund. 2023 has been a strong year so far for the fund. We've outperformed our benchmark, which has been Nifty 50 since inception. And 1 rupee invested in the fund roughly would be worth 3.45 today. This has again beaten Nifty 50 from a healthy margin since inception. What does this mean today? From an IRR perspective, an investor who's been through the fund for the last 6.75 years would have compounded at 20.1% net of fees and expenses, as against 13.96 on Nifty 50. So this amounts to a fairly healthy outperformance of 6.1%, despite 2 years of underperformance of the fund against Nifty. One of the important aspects I want to highlight is at Itus, we run a multi-cap fund. What does multi-cap mean, and how do we think about market cap-based positioning is something I'll take you through during the next few slides of the presentation. But it's really important to understand, why do we benchmark ourselves against Nifty 50? So when I started this fund back in Jan 2017, I'd maintained that Nifty 50 would be the most consistent and hardest to beat index in India. When I say consistent, it doesn't mean just absolute magnitude of returns. It also means the drawdowns that you get protected by during every bear market that you go through. And we've roughly gone through close to 3 bear markets in the last close to 7 years of us running the fund. So what we've done here is taken, for example, all the indices that funds in India typically get compared to. And as you can see, irrespective of which index that you take, Nifty 50 at an absolute return level is one of the best performing indices since inception. Now, because of one of the reasonable bull markets that you are in, mid-cap has outperformed this year Nifty 50 by a healthy margin, but otherwise, Nifty 50 has pretty much beaten every index hands down. Now, the second important aspect is one of the hardest things about public markets is less so the returns, but more so the time that you spend in any fund that you invest in. And the reason most investors spend very little time in a fund is the drawdown that every fund goes through during different intervals. And as you can see, when you measure the volatility of the various indices, you would understand what I mean by drawdown protection at Nifty 50. And for us at Itus, when I say we've beaten Nifty 50, that's one part of our job done. The second aspect of our job is effectively to keep the drawdown much lower than that of Nifty 50. And that's the only way we aspire to keep investors for long durations of time, because there would be periods of underperformance. While we try and negate that at every year, there could be periods of underperformance. But if we can minimize volatility at every stage, that increases the probability of an investor staying through the course of a life cycle of a certain fund. So this is what I mean by saying that Nifty 50 has been the most consistent index from the start of the fund. And I would go ahead and maintain this, saying that in this decade, which pretty much everyone on this call and most FI allocators who are coming into India today believe that this would be India's decade in terms of the GDP growth that you expect from our country. Nifty 50 will continue to be not just the best return index, but the best drawdown based return index that we talk about. So with this as the background and performance out of the way, I wanted to take you through how we think about market caps, because we are not constrained by saying that you need to have a certain percentage in a certain market cap when we run this fund. However, since inception of the fund, we have not taken our small cap exposure significantly above 25% at any point of time. And there is a reason for this. So let's break down the constituents of the components of the listed universe in India. What we stick to is the top 500 companies. We don't go below that, because there again, liquidity gets sacrificed, and liquidity is a very less so discussed subject from a risk management perspective, but according to us, one of the most important aspects of risk management. Let's keep liquidity aside for now. What we have done in this is we've taken every bull market in India since 2004. And we've compared the returns of the large cap, which is the top 100 companies in India, and the small cap, which is the 250 to 500 companies of India at different points of time. So we are not biasing to any particular segment or time period in the market where any index could have outperformed or underperformed, because we don't know. Second, we go way back in history to ensure that we capture as many bull markets as possible and as many bear markets as possible. So as you can see, what we have done is neither do we know when an investor comes in, nor do we know when an investor goes out, because that's purely psychologically driven. It's headlines driven, and it's more so a mental mindset driven. So we are not sure anyone can time the markets. So let alone, we don't have any bias towards that. So what we do here is the first two columns that you see is the 1 year return of small cap stacked up against the large cap. And as you can see, on a 1 year basis, the average outperformance of small cap is roughly around 4% that higher than that of large caps. And that is justified primarily because on a 1 year basis, you could have small caps massively outperforming large caps. You've seen that over multiple years. You're seeing that this year as well. Now, as you go into slightly longer durations, let's call it 3 year durations, the gap begins to narrow. What do I mean by that? The average return of a large cap versus that of a small cap is pretty much mirroring each other. There could be certain cycles where you could have exploited this much better. But if you say that you are a long-term investor and you want to be invested across cycles, the difference between a large cap and small cap diminishes. And if you truly are long-term, which means if you're invested in the markets over a 5-year period, then you begin to question, is there an additional alpha? And here again, I'm saying I'm investing in indices, which means I don't have the ability to stock pick, right? I am invested in an index which mirrors a large cap or a small cap. That's where I'm coming from. Because more often than not, people take this view that I have to go overweight small caps because it is performing. The average return of a large cap is actually higher than that of a small cap, right? The reason this happens is because of the drawdowns. The drawdowns in a small cap take away a lot of your returns over time. So what average does is And what rolling return does is it takes away the period of any particular bias where one period something could have done much better than the other period. I don't know what that period could be, but if you average it out over long periods of time, then you are removing any particular impact on cyclicality. It's important to remember this primarily because the index return or any portfolio return that you are going to make as a minority shareholder of businesses that you own is going to normalize to the growth rate and the ROE accretive growth rate. What does that mean? Every company that grows does not generate ROE accretive growth, which means it does not generate ROEs higher than cost of capital. And if that happens, your growth rate is actually destroying shareholder value. So it's important to understand this concept as well. Now, with this as the background, let's look at our own exposure of how we have increased or decreased small cap, because we've been decreasing small cap exposure over the last 1 or 2 months, and and as I speak today into year end, you will see us continuing to decrease our small cap exposure and increase our large cap exposure. Now, there is an element of stock picking also, and that's the reason we are running a fund. We will not be in existence if we don't generate alpha over long periods of time. So this again is just bucketing it based on market caps. Now, if you look at the first time where we increased our small cap exposure significantly, it started between 19 and 20. And it was the same time your ROEs in small caps began to expand. Now, if you go back into the reason why, there were two reasons. Corporate India began to delever at that point of time because we were coming out of an NBFC crisis. Alongside that, many of the companies had invested in capex and they were accruing the benefits of operating leverage because the demand was coming into India. So small caps did benefit out of that as well. And as the ROE accretive growth began to expand, there were more and more niche companies which we were able to pick from a bottom-up perspective and increase our allocation. Now, one aspect of that allocation is growth. Second aspect of that allocation is ROE. The third and most important aspect of that allocation is valuation. And this is subjective. Because end of the day, I cannot give you a number and say beyond this, don't invest, or less than this, invest, because that's not how investing works. There is a certain level of art to it, which basically goes into the qualitative aspect of investing. Today, why are we reducing our exposure? Because the marginal returns that we get. So let's say pretty much everyone is on this call is aware of PE, because many of them uses that as a filter to invest. But let me just reverse that and call it earnings yield. The earnings yield of small cap today is roughly 20 basis points higher than that of large cap. And it's my humble submission that the liquidity that you will sacrifice, 20 basis points is not enough a pickup for me to go and invest to sacrifice liquidity. And hence we are cutting down our exposure in small caps as we speak. Now, the second question that I often get asked is, what is your view on macro? And I'm sure there are many questions today which basically will address things like war, things like oil prices going up. And these are macro related questions where the probability of us getting it right is pretty much 50-50, right? Many people need to acknowledge that. While I might say with confidence, I know how the world is going to, answer is I don't, right? That's the reality. So it's really important to understand in the last 13 years, which includes the last decade of suboptimal growth for India between 2010 and 2020, how did the so-called market that we all use, quote unquote, which can be benchmarked as Nifty 50, react? So in the first table, what we have done is taken the max drawdown on Nifty 50 in any particular year. So what that means is I don't know where the peak of that market in a particular year is. Neither do I know where the trough of the market or the bottom of the market on that particular year is. I only know that with the benefit of hindsight. So in the last 13 years, what is the peak to trough drawdown? Because that is what is volatility and that's what scares people. So Broadly, if you look at it, there were two significant periods in the last 13 years of a reasonably big drawdown, which was 2011 and 2020. 2020 was a one-off, primarily because the world kind of came to a standstill because of COVID. 2011 was a much deeper macro and a micro related problem with India specifically too. Macro began with Europe, Greece, Italy, multiple countries were on the verge of bankruptcy. And in India, that resulted in FII money fleeing, INR depreciating massively, and it's coincided with oil price spike up of almost doubling of oil prices at that point of time. All this hurt our current account deficit, and the macro turned extremely sour. So if you leave these two periods, on average, if you basically say, when I get a peak to trough drawdown of 10% and I invest, you are significantly taking your odds in your favor in terms of getting into the market at the right time. Right? It's important to understand this because everyone wants to know how to time. And the answer is no one knows. Neither do I, and nor do at least 90% of the people on the call. Maybe there are 10% who know how to time. But when you use this data point as a reference around how do I increase the probability of me allocating into the markets, this is one such data point. Now, this is max drawdown, which you will know only from the benefit of hindsight. What about the start of year to trough? This actually basically is telling you from 1st Jan of that year to the lowest point on that particular year, what is the drawdown that the market has experienced. Again, much lower than peak to trough, as you would imagine. But again, if you use that 10% as a benchmark, you will never get it right, but you will increase the odds of investing. So I always urge people, rather than discussing, okay, what do you think on war? What do you think on Hamas? What do you think about oil prices going from 90 to 105? These are all genuine risks. And the answer is no one knows whether you think or not, you have a view. But the question is, can I increase my odds of investing at times where the price and the valuation are reflecting that fear? You keep doing that consistently over long periods of time, it's like increasing the odds consistently and you will outperform. With this as the background, it's important for me to spend some time on investing in themes. What that means is I'm a big believer in cycles. And at different points of time, you, as a fund manager, need to keep evaluating where you are in the cycle. What do I mean by that? Pre-COVID, if you look at the Itus portfolio, we were a lot more consumer focused, as well as consumer financials, maybe specialty chemicals used to be a significant weight in our portfolio. Post 2021, our portfolio has shifted a lot more towards the supply side of the equation, which basically means manufacturing, B2B, auto anchors, real estate anchors, which basically comes to the GDP facing side of the economy. The consumer has diminished in terms of our allocation. That doesn't mean growth is slowing down. It means valuations are a bit too expensive for us. Now, one such theme that we keep talking about is the financialization of our country, where we basically play out this theme of this $3.5 trillion economy that we are in, going to $7.5 to $8 trillion in this decade. Right? So let's not argue about the time, but this theme should play out in this cycle as we see things with the visibility that we have. So let's establish what does the story tell us and what is the narrative telling us. Typically, huge money is made in public markets if you get these three right. Investing in market leaders, investing in markets where penetration is low, and investing in great management. Obviously, all three you will know only with the benefit of hindsight, but if you take any company which has compounded at 20+% over 10 plus years, you will find these three themes, these three characteristics. The important thing is these three characteristics are known only with the benefit of hindsight. But one such theme that we are facing in India as we speak is financialization. Now, In order to discuss financialization, because a lot of people are aggressively investing in brokers as we speak, and that is one area where I am where I feel risk reward is not right. And I'll just explain why. Even though financialization might happen, it's important to understand what kind of financialization is happening in our country. Right? It might change, but I'm just presenting the data points as we see it, such that it's food for thought for anyone on this conversation. So this is roughly the income tax filers in India, not payers, filers, because it also includes people who file in the lower end of the category. And the expectation is the lower end will start moving into the higher end and the consumption will keep increasing. That's what people expect in the next 10, 15 years. And you should see that happening. But the income tax, the takeaway from this is in the last 4 years, the good thing is we've seen an absolute growth, not a IRR. It's an absolute growth of 12% in the filers in India over the last 4 years. As against that, why did this theme of financialization come? Because of these numbers. You've seen 220% growth in demat accounts, 281% growth in NSE active clients, as a result of which the equity culture in India has also gone up, which is what you see as 71% growth in equity-oriented folios. And you're seeing that in terms of the number of mutual funds setting up, new AMCs coming up and setting up mutual funds, SIP volume, which used to be roughly 9,000 crores per month, gone up to 16,000 crores today, should go up higher. So all of these trends that you're seeing is as a result of this. Why is this important? It's my belief that the number of demat accounts has a linkage to the total taxpayers. What do I mean by that? So let's take lending market for an example. In the latest quarter that Bajaj Finance disclosed, Bajaj Finance said that it lends to an active client base of 7.3 crores in India. What that means is you have 6.3 crores of tax filers. So Bajaj Finance has gone beyond the tax filers and created a market outside the tax filers for lending. Is that a good thing or not? I'm not commenting about it. That is for each person to make a conclusion, right? But in the demat accounts, I don't see that happen because that's your addressable market. Your addressable market is not 150 crore population. Your addressable market is your tax filers. Because if I'm going to create a demat account and trade, then and I'll give you some data points on what this trade actually means. I'm going to have a tax liability or a tax accrual to pay. And hence, I believe that that's my addressable market. So what used to be 15% in India 4 years back is now close to 60%. We reached 60%, it's come down a bit. So the financialization of India, this is what we are talking about. Increased demat accounts, increased NSE active clients, increased number of equity folios. That's the good aspect because that's long-term, hopefully investing. And this is where the discount brokers picking up. You see in the listed market player like Angel One creating huge cash flows, now expanding its market size in a significant way. And in the private markets, multiple players doing the same thing. Now, let's just take because we have the listed market data. This is the data point for Angel One, which is a proxy for most discount brokers in India because pretty much everyone is lowering the price. Everyone is encouraging trading as we speak. So in Q1 of FY20, the cash to derivative volume that was actually transacted on Angel One was 73% to 19%. What that means is predominantly people who transacted on Angel One they were trading on the cash volume, which basically meant they were taking delivery. They could still be doing short-term trades. I'm not commenting on that because I don't know, but they were taking delivery of shares. F&O was much smaller. Today, that same number is completely shifted on the other side. So 26 million orders per quarter has scaled up to 230 million orders per quarter. So 10x in the last 4 years. And that complete shift has actually gone on to the F&O market. Important thing to realize as we go forward. And as you can see, in order to capture this market, you see the number of discount brokers and the optionality that an average investor has today in order to transact and what we call as financialization. Now, it's really important to break down something around who we are as Indians, because India is a very, very unique market. And we all like to say, okay, we saw this trend in the US, we saw this trend in China, and you're going to see this trend in India. You will see this trend, but India will always be unique. And this is one such table to show what is unique about India. So the first, I'll just quickly go through what this table means. This is all the exchanges in the world. The top exchanges in the world, what it does is on a monthly basis, calculate the ratio of the derivatives to the cash market. So what does this mean? In July 22, the total volume of derivatives divided by the total volume of cash, our ratio was 237. The next in line, which was a German Deutsche Börse, was 27 times. Today, that ratio for our country is 421. So what it means is, as we financialize what is actually happening on the ground, number of demat accounts are certainly increasing. The derivative volume is going up. And you will see that with what is happening with BSE. You're also seeing that with, if you follow the private markets in terms of the cash flows that someone like an NSE is generating, you'll see that as well. So end of the day, today, all this is great for the brokerage market, but if you look forward, I'm not sure this growth can continue because you are saturating on the addressable market. So if you really want to be playing the discount broker market space, then what you have to think about is there a way for our total tax filers to increase? If that can increase, then you have a long runway for growth. And if that can't increase, you have to question what you're playing. So it's really important to put certain things in perspective when you are playing a story versus a narrative game. So again, I'm not saying what's good, what's bad. That's for people to take their own judgment. But when you play a certain story and when you look back on numbers and say, oh my God, a discount broker market is growing at 45%, it's important to put in context what this means. And more importantly, can this growth rate sustain? Now, with that as the background, we'll come back into our portfolio. So from a numbers perspective, how has our portfolio seen growth? Because that is the essence of what we do. We invest in growth, we invest in market shares, and we invest in good companies who are able to actually grow way higher than the market. So if you look at our portfolio, on a year-on-year perspective, both the revenues and the PAT has grown on a significant way. What you will see is the revenue growth is much higher than the PAT growth. Why is that happening? Briefly, somewhere in the early part of the conversation, I spoke to you about our portfolio being manufacturing and auto intensive. And you will see us adding value and adding exposure in these three segments. All these three areas are where companies are expanding capex. At a time where companies do capex, you will see higher investments, higher depreciation, lower earnings, as a result of which your PAT will temporarily get depressed. And as the demand cycle continues, you will start seeing that accretive into your bottom line in the next cycle. So that's the reason why this is happening. But from a health of the portfolio perspective, it's never been stronger. Why do I make that statement? Because the gross margin, which is what I call the pricing power of our portfolio, continues to expand. So even during the stage of actual expansion, you have not lost your pricing power at a time where inflation is actually picking up at a global level. So both your return on incremental capital as well as your pricing power has not been lost in this portfolio. And this is one aspect that has been very important to us. How has our portfolio stacked up on a return on incremental capital basis? And as long as we can keep picking companies whose ROIC continues to expand, the chances of us outperforming in the long term will continue to increase. And that's exactly what we look at doing. So here again, what we've done is we've broken down our portfolio into the themes that we are invested in, the weights to tell you the exposures that we have. And it's the same thing that I spoke to you about. And in the last 4 quarters, what has been the top line growth? So the two things that we want to be achieving with our portfolio is position towards those themes that are seeing growth and position towards those companies that have market leadership, ability to have pricing power, and expand on that ROIC. Combine these three together, your long-term returns should beat the benchmark that you are actually mirroring yourself against. Before I finish this presentation, I know pretty much everyone has views, questions on macro. So I just wanted to spend some 2 minutes on certain media-based narratives that everyone keeps reading on a daily basis. One of the big narratives that people keep reading about is China and China collapsing, China finished. Those are the common themes. So let's take some data and let me just present that data to you for you to make up your own mind. In any economy that's going into the verge of a crisis, or let's say is already in crisis, the banking system will always reflect that. Why is that the case? Because that's the system which is most levered in any country. You go back in time and look at the US, where the mortgage crisis preceded the 2008 GFC, the banking index collapsed, right? So that's what this chart actually shows. The same thing in 2011, I spoke to you about why India had a 26% peak to trough drawdown. It was on the back of the Eurozone crisis. There again, it was preceded by actual banking system collapse. China banks, at the moment at least, don't signify any kind of a catastrophe, right? It seems in a healthy position as we speak. Obviously, we can all make up our mind. We can debate whether it is fraudulent and they are getting protected. But purely from the market's perspective, I'm just commenting on the fact that it is not yet heralding a meltdown. In fact, it's actually quite contrary. It is US banks which are actually massively underperformed in the last 1.5 years versus China. And the reasons pretty much are well known. It's got to do with treasury, the bond sell off. But US banks are in a much worse situation than actually that of China. Here again, if China is really imploding as the world's largest consumer of commodities, you should start seeing that in commodity prices. That is not getting reflected as we speak. If I then look at consumption, and tourism and gambling are a proxy, according to me, for consumption. The Macau actual tourism arrivals are returning back to pre-COVID levels as we speak. The China vehicle sales, which is auto and auto consumption, seem to be extremely healthy as we speak as well. And finally, true reflection of consumerism, which is Alibaba's revenues. They recorded their strongest first quarter on record since inception of the company. So there are two narratives out here. So start looking at media narratives. You can trust it and you say that China's struggles are real and everything is going to unfold. And it's important to understand because I don't come from the school of thought that China is going to unravel itself and India is going to present itself as the beacon of hope. I think in this decade, you're going to see EM do well. As a result of which, for EM to do well, China cannot collapse. Right? You need China to hold in there and India will outperform because of India's exposure both in FII portfolios, India's exposure in manufacturing, India's exposure in world consumption will go up. So end of the day, I personally believe that China is not collapsing yet. There are problems and the problems are genuine. Its exposure will come down, but it doesn't mean it is collapsing. It's important to just appreciate this before we move on. Our own portfolio, again, what should an investor expect? We should expect we continue to invest in growth, backing the right promoter, because for us, we invest behind the right people. We want to be long-term owners of businesses, but we invest with 3-year horizons in mind. The way we think about long-term is a series of 3 years, because beyond 3 years, it's hard to see for anyone, at least hard to see for us. And we will want to be only fully invested when we get a margin of safety in each of our investments. And at a portfolio IRR of close to 18 to 20%, you will see us get fully invested. So valuation is extremely important for us. This is how I would conclude our presentation. We can now open the floor to questions.
Thank you, Naveen, for the wonderful update. Participants who have questions can feel free to type your questions using the Q&A button. The identity of participants are protected as the questions are only visible to the panelists. I have a question. So in my discussions over the last few months with allocators from Europe and US, there seems to be a significant interest in investing in India in the emerging market space. Are you seeing a structural shift in this direction?
So it's an interesting question that you ask, Ajit, and it's interesting because of the time that we are in, right? So during our conversations with multiple allocators as we speak, I think many of them do have a certain dichotomy in mind. So if you take any index, so an allocator invests based on the actual country exposure. Today, if you take an EM or an Asia index, China's weight is 35 to almost 40%. India's weight is 5 to 6%. Now, China's weight, while they have not made returns in the last 5-7 years in China, to compensate for that, the valuation has become extremely cheap. So at the moment, their dichotomy is they certainly are not pulling out in a big way in China, but they are really thinking for this valuation, I'm getting paid to take this risk. In India's case, they have been underweight. They have to increase their weights. The contrary to that is the valuation is something that they are also questioning. So this is the push and pull in both factors. What I see happening over the next year and a half, as you start finishing at least the initial round of conversations on elections, and hopefully you get more news on stability, is the fact that foreign allocators will continue to increase allocation to India. Maybe the 6% that is there today should go to 9 to 10%. That means it might sound small on an absolute basis, but on a relative basis, it's a 50 to 60% jump in allocation. But I don't think China money is pulling out or getting out in a hurry, according to me at least. So I think these two are independent, and data points do show that China is not on a structural collapse. Yes, the state wants to keep the IRRs within the state rather than for foreign investors to make their IRRs. So that's what a foreign investor is debating with as we speak.
Understood, Naveen. Thank you for this. So now, in our portfolio, when you look at adding businesses, how do you measure the promoter's quality?
So the promoter's quality is, so it's like this, right? So how do you hire? So let's say when you are hiring a senior management person for your company, right? You start off with your resume. Why is your resume important? Is because it highlights your achievement. It highlights how well you've done in the past. If you have nothing to show for your past and you tell me you're going to do something miraculous in the future, I'm not interested. So the first thing that we look for in the promoter is history. What have they done? Today, for example, if you were to invest in a fund manager, the first thing that you would ask for, hopefully, is 5 to 7 years of track record and how that fund manager has done during bad times. It's the same thing that we look out for. When we look at a promoter over 5, 7, 10 years, we have 3 to 4 cycles where the economy went through a downturn or the business would have gone through a downturn. It's important for us to evaluate how did the promoter do during those and what kind of capital allocation did they do during that time, because that defines what they're going to do today. Today, you are seeing increased M&A activity. Hospitals are investing in diagnostic chains because they are increasing their cash flows have increased significantly. So this is the time where a lot of mistakes are bound to happen during good times. So we are not evaluating a promoter during good times. We want to be evaluating them during bad times. That's what history tells you. Second thing is we want businesses that have seen multiple cycles predominantly for the same reason. Stability of management is extremely important. We don't want CEOs change every 2-3 years. We would ideally like managements with slightly longer track records. Then little things around corporate governance. How do we manage that? You talk to the distributors on the ground. You talk to retailers on the ground. You kind of do channel checks. Not each one is never going to tell you the full picture, but each one is going to give you additional information around what you should look for in the next period. Then things like your auditor. What is your auditor remuneration? Has it increased abnormally during one particular year? What kind of related party transactions do you see on the balance sheet? All of this put together has generally tends to give you clues. As long as you then position yourself with what we call the highest probability promoters who've invested and done the right things during bad times, you will tend to actually make money, because this concept of a good promoter is always known only with the benefit of hindsight. What you're trying to do with all of these channel checks is reduce your mistakes. If you try and continuously reduce your mistakes, longer term, your portfolio should be in better health. That's what we look at doing.
Sure, and thank you for this. What is your view on Sumitomo Chemicals in our portfolio, and how do you see the chemical sector evolving?
So I think chemical sector is certainly, it's no secret that it's going through a downtrend as we speak, and that downtrend has predominantly come from, like I said, I believe in cycles. You've seen a good up cycle, and now you're in the middle of a down cycle. The down cycle has been accentuated by the fact that China has been dumping in the market, and the prices of these chemicals have gone down. So the actual benefit that they got between 17 and 20 and 21 is now going off between 21 to 23. Somewhere along this, it should stabilize. I don't know when. I think one should price in another 1 to 2 more quarters of pain as we speak, but it should stabilize. And once it stabilizes, you want to be invested behind those companies which have an R&D backed edge behind it. So specifically Sumitomo Chemicals, if you ask, the interesting thing about the company is the R&D has been subsidized by the parent, as a result of which the molecules that it manufactures, a lot of it comes under the specialty chemical segment. Today, everyone I know uses the word specialty chemicals liberally, but for us, the way we measure specialty is, can you protect margins across cycles? And you've just seen one down cycle. So if you can protect those margins, be it gross as well as EBITDA, then gross basically tells you your R&D expertise. EBITDA basically tells you your operational expertise. You combine these two, then you have a certain edge in terms of the company that you run. So net, I still think one or two more quarters of pain. And after that, if you should get opportunities to position yourself around good companies. And we believe Sumitomo Chemicals is one such.
Understood, Naveen, got it. Now, how do you see the impact of US rates remaining at the current levels for the emerging markets? Or do you see if the rates move up or down, will it impact the emerging markets as a whole?
Okay. So I think first thing, again, this is a macro related question, right? So whoever asks this question, all I would start off by saying is the best case estimate for me to give you a meaningful answer that is right is 50-50. Please realize that. If I had told you a year and a half back, US rates are going to go from 0 to 5. And I asked anyone on this call a question, which sector do you think is going to be the most impacted? If you can think for 2 minutes, the natural sector that comes to mind is technology. Because technology is one sector where your terminal value is extremely high. So at a time where your rate of change of interest rates increases significantly, then your terminal value drop is the highest. What do I mean by that? Typically, if your terminal value into the present value of a company is approximately 85%, which is what it is for tech companies, a 1% change in terms of interest rates, if you discount it, drops your present value by 20%, just to put that into perspective. So you just went from almost 0.25, a zero rate environment, to 5. Then you can make your own guess on what tech should have been. Let me just show you a chart to just explain what happened. This chart is NASDAQ 100 to Russell 2000 ratio, right? So basically NASDAQ 100 is tech heavy, Russell 2000 is small cap heavy. So the best performing sector in this ratio, you have surpassed the previous peak of the so-called dot-com bubble. If you had told me 1.5 years back, I had the ability to know that US rates are going from 0.25 to 5. What is one sector I would reduce my weight on? Pretty much unanimously, everyone on this call would have said tech. But instead, it's been the best performing sector. So all I'm saying is, do I have a view on rates? Yes, higher for longer. How do I protect myself in positioning portfolios? Go after growth and good companies. Rather than saying, I know where my rates environment is going to be 1 year down the line, because that's a fool's exercise. So rather than going down that path, the path that I would prefer to go down is, how do I position myself if something goes wrong? I would position myself towards higher growth rather than saying, I know which sector is going to do well, or because rates are going to go up or rates are going to go down. Because answer is Fed doesn't know. So there's a very little likelihood of me or you or anyone on this call would know. So that's the only thing that I would say.
Got it. I mean, understood. Now, with domestic institutional investors increasing their equity allocation steadily, now would this temper the equity returns over time?
Again, it's a funny question, right? Because if investors allocate more money, people are happy. But now the question is, if investors are allocating more money, would the returns drop? Right? Answer is one, you'll have to be very clear. What do you want? Do you want investors to invest more money in the markets, or do you want investors to invest less money in the markets? The point answer is, when you're, see, you know what your average returns are. Corporate India will grow at GDP plus inflation. GDP plus inflation for our country is 10 to 12%. So corporate India will grow at 10 to 12%. Great companies will translate the 10 to 12% of growth into, let's call it 14 to 15% of cash flows, because they have operating leverage on top. If you can manage to buy those companies at a reasonable valuation, I'll say reasonable because you're not going to get such companies cheap, the chances of you making money is higher. That is all that we look at doing. If more money comes, will the returns go down? I don't know, because we all want more money to come. So I don't know why the returns should go down. Returns will go down if your returns get front-ended. So if you are looking at a portfolio that has made you 40% IRR for some strange reason, you have to question, why are you invested in such portfolios? Because the probability of you continuing to make 40% IRR is going to go down as we speak. So that's all I would say. So I would urge people to think in probabilities rather than in zeros and ones, because the world doesn't operate in that way.
Got it. I mean, understood. So this is a question saying that what is the downside do you expect in this financial year with increasing bond yields, with looming war situations and all that? Do you see a downside, or it's probabilistic answer to it?
I mean, I don't know. Again, like I said, these are questions that answer is, you can give very confident answers to a broad audience, right? And when you address things publicly, people expect confident answers. But the honest, you have to keep things honest as well. Honest answer is, I don't know. Markets went from 0 to 5%, whereas while we are talking about India at all-time highs, US also is 3% of all-time highs. So at a time where rates have gone up significantly, it doesn't make sense from a macro perspective, right? This is not what I would expect either, but that's where we are. So the question is risk right, or is risk reward wrong? Now you'll have to go deeper down. What is holding up US stocks? What is holding up US stocks is the 7 technology companies today as we speak. So if you take a value weighted index, so equal weighted S&P index, today S&P is market cap weighted. Market cap weighted S&P, I don't know, somewhere around 4,300 as we speak. That's where it closed yesterday. Maybe I get a few percentage off wrong, but it's somewhere around 4,300. But an equal weighted S&P index is roughly at around 4,000. So what that means is a small set of stocks are holding the index up. So is the index the right value, or do you need to position towards growth? So to me, I always ask myself, and that's the theme of this presentation, rather than breaking our head about, is the index level right? Or because of war, should we be 10% lower? The only thing that we can answer at a micro level and position ourselves well is position ourselves towards growth, and how are we constructing things at a bottom up perspective and ensure we don't overpay to own businesses. Those are the things under our control. If you can get these three right, the rest of the things becomes a viewpoint, right? A viewpoint of mine versus yours is never a good argument. If you're asking me, do equities and bonds at these levels make sense? Answer is no, but that's where it is. So one needs to be sensible in terms of what valuations you need to pay today at these interest rate levels and where you want to position yourself. What I broke down in terms of where we are positioned is where I see higher visibility of growth in the near term. And that is what will protect us if we do go towards the downside. The second thing that we will get protected is the fact that I have been moving small caps towards large caps, which means liquidity is going to be higher. And the third thing that's going to protect us is we are not fully invested, we have cash. So put these three together, it gives you a sense of how we are thinking about it. But we will never come out and say market has to fall, because these are again 0 and 1 statements. You don't live in a world where you can make 0 and 1 statements. You live in a world where you think probabilistically and you increase your odds of success in investing.
Understood, Naveen. Thank you. So, I have the last question here. So, what is your view on pharma, hospitals, and the diagnostic sector?
Again, three very, very different sectors clubbed as all pharma in India, right? So, pharma and hospitals, I think, has interesting bottom-up opportunities to be positioned on. Hospitals have already reflected that because they have front-ended the growth. We've owned hospitals as well. We've trimmed down our exposure in hospitals as we speak. Diagnostics have near term, you could see some mean reversion based returns, but I still think diagnostics, you should price in 12 to 14% volume plus price growth. So for 12 to 14% volume plus price growth, what is the valuation you want to be paying to own the diagnostic companies is something that one has to make up their minds on. You have quite a few listed players today. You have many more in the unlisted markets, and you have hospitals today entering diagnostics because they are throwing up free cash flow that they have never seen in the last 10 years. So end of the day, the competition is also picking up. So do we want to be positioned ourselves in diagnostics? Answer is no. We've exited. We wouldn't want to be today. But in terms of pure play, pharma, domestic manufacturing, and hospitals, I think there are some good, interesting opportunities there. And if you see our exposure, we do have a reasonable exposure in those buckets.
Understood. Thank you, Naveen, for this. Maggie, you can take over.
Sure, Ajay. So thank you, Naveen and Ajay, for this interesting updates. And once again, I thank you all for taking the time out to be a part of the call and for your patience on the call. So the recording of this webinar will be sent out once it's available. Have a wonderful weekend.
Thank you, everyone, for this.